Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. From Orlando, Sonu, we just recorded episode 100 of the Facts versus Feelings podcast. We titled it Celebrating Bull Markets in episode 100 with Tom Lee. How fun was that?
The one and only Tom Lee, right? S&P 15,000, S&P 6,000, I think, is this call
By
for
this
year end. I mean, look, we're bullish. We're celebrating the bull market, and why not, right? And nice to do it from a nice sunny place in Orlando as we speak.
Yeah, you wait 10 minutes, it rains, but nonetheless, it's old. As you said that, literally the sun just came out right there, as you said, a sunny Florida. But listen, we are so honored and delighted. We recorded it a little bit ago. You're going to absolutely love this week's Facts versus Feelings with Tom Lee. We've done 100 of them. This hands down was one of the best ones. We did in front of 1,000 of our partners, or almost 1,000 people live. We also live streamed this to thousands and thousands more people. But we're just honored that so many people listen to this podcast, come back every single week. You keep listening to it. We're going to keep doing it. Without further ado, here is episode 100 with Tom Lee. Oh, actually, we could probably do a title. Tom Lee, hopefully it's
founder and
CEO of Fundstrat. We have to do titles. We kind of forgot to say that, so I had to get that in there. But enjoy episode 100, and we'll be back next week with episode 101, talking about more stuff. But enjoy this one. Take care, everyone. Thank you. Everybody. Hi, everybody. Hello.
All right.
How you doing? A little bit ago, I walked and nearly broke my neck on that little step. It's amazing the older you get how those things happen. Good afternoon, good morning. We are so excited. This is episode 100 of Facts versus Feelings live in front of about 1,000 of our friends right now. We are live streaming this as well, and then tomorrow it'll be wherever you get your favorite podcast. So we're very honored and delighted to be joined by Sonu, as always. We'll talk to Sonu, no offense, and me. But Tom Lee. Tom, how you doing?
Very good. Thanks for having me on your 100.
Yes. As everyone knows, Tom is a legend in our industry. We were talking, who should we have? And we said, let's get Tom Lee. So Tom will go to you in a second. If you want, go ahead and tweet out the live stream and go ahead. I'm going to talk to Sonu for a minute. 2 years ago in Las Vegas, we did our first episode of this. And here we are 2 years later, episode 100. How much fun's it been?
No, it's been fantastic, right, doing this and just getting feedback from everyone and being here, with Carson Advisors, being part of the community. I was just thinking back to why we selected, when we were thinking about what do we name the podcast with Joey Goodry and yourself, and we were sitting together, Facts versus Feelings sort of seemed natural. And what's interesting about it is, I think of it, it's not really facts versus feelings, it's about facts and feelings. What I think we do well, what I think we do well is, we look at a lot of data, right? But we create stories too. And I think that's why we spoke about having Tom too. It's not just about, yes, you have to go through the daily grind of looking at data and all of that, but you have to create a story. You have to create a narrative about that. And I think that's what you and we do really well, I think.
It's a blast, right? Doing 100 of these. We have so much fun doing them. And some of the best parts about it are when we have awesome guests like Tom. Yeah. So Tom, what a emoji gift did you just use? We were joking about what I used.
Well, maybe I
should say the title of this episode is Celebrating Bull Markets.
Yes, episode 100, celebrating the bull market with Tom Lee.
All right. Can the camera zoom in?
There you go.
All right,
that's it. So, Tom, let's just, that's funny.
Yeah, you can see it.
Let's start from the beginning. You're Fundstrat. You started Fundstrat. What do you do all day? How do you help the investment community? And how, specifically, obviously, a room full of advisors out there, how do you help financial advisors?
Well, we have a very large research team. At JP Morgan, which I was there for many years, I had a research team of like 3 or 4 people. Today, it's almost 20. And we spend most of the day ingesting all this information from the markets. And I think really try to do 2 things. One is try to find signal, which is our evidence-based research. But I think what we also try to do is find out where maybe the consensus view might vary from the most probable view, and then that's where opportunity emerges.
Right. So I think one thing, which I think for the rest of the crowd, for everyone listening at CNBC, was like, wait a minute, you really said that? S&P at 15,000, S&P 15,000. What drove that, and what gets the S&P 500 from where it is now? I think, 5,400, 5,450, something like that, to, 15,000 by 2030, is that?
Yes, by roughly 2030. And, I know some people might say, Tom, S&P's, at 5,000, how does it get to 15,000? One thing to keep in mind is the S&P today is 5,000, but 15 years ago, it was 600. It's gone up by 10 times. And we're not saying it's going to go up by 10 times. We're saying it's going to roughly compound at roughly 15% a year. Well, if you look at median PE, it's 16 times right now, by the median stock. If you grow the PE towards 20, that's roughly 2% a year. And the question would be, can you compound earnings at 13%? That's the historical earnings compounding, of which 4 or 5% comes from buyback. So just a normal cycle will get us to 15,000.
That's good perspective. You're talking about next gen and young investors, something to keep in mind.
Yeah, it's the time value money.
So that's the big view, and obviously with a room full of financial advisors, hearing something like that is probably music to a lot of ears, and you've been very, very right. Let's talk more right now, right? September, as everyone said. And by the way, the market sold off last week. Tom was on Monday morning on CNBC. They blamed you for the weakness last week when you came out a little bearish, and you've been bullish. I want to dive in, but September is the worst month the last 10 years, the worst month on average the last 20 years, the worst since 1950, the third worst in an election year, with only October being worse in an election year. So the calendar, and then boom, last week was the worst week since the regional bank crisis, about a year and a half. What is your near-term outlook the next 6 to 8 weeks or so?
We're cautious. We told our clients that, the best you can hope for is a range trade. So the downside being 5,300 on the S&P and the upside being 57. 53 would be roughly a 7% drawdown from the high. And I think we're pretty much there. I think the August lows of 5,100 on the S&P will hold. That's something we've advised our clients. But volatility probably doesn't peak until October. Since 1928, the VIX his delivered volatility doesn't peak until October 64% of the time. So I think it's not going to feel good, but the August lows hold.
I have a question on that. You mentioned September has historically been weak. So much of what, Ryan, you do is about seasonality. It's probably a question for both of you, and I've wondered about this simply because I don't have a good answer to it. What drives seasonality?
I heard something from Jeff DeGraff, and it's probably the most reasonable explanation. He said that when we were an agrarian nation, in September, people had to sell their crops or raise money to buy the seeds for next year. So September was a drawdown because people were selling. The only reason I'd say it kind of makes sense is that markets are weak in April for the same reason, because people are raising money for taxes. But why is September a bad month? I have no idea.
It's probably for a similar quirk why we have elections on Tuesdays. I think it had to do with farmers traveling and things like that, making it to their polling places. But yeah, it's just interesting.
So on Monday, we saw your note, as always, excellent note. You listed 6 reasons, big picture. You're still quite obviously optimistic and bullish once we maybe get through this seasonally weak pre-election jitter timeframe. Don't need to go through all 6 of those. What are some of the reasons that you think, again, for financial advisors with their clients who are worried about the dip, the volatility, election, why going out, next year or so, you're still pretty optimistic?
Yeah, I might just share 3 of the most important. I know you guys like to cite stats. I see yours all the time, Ryan. So I'll share a few. First, the advanced decline line on the S&P made an all-time high. You've never not subsequently seen an index all-time high. And even if you think this is 07 again, which it's probably not, that means within 5 months, we're going to be S&P 5,800, 6,000, something like that. The second is, and this is more in your bailiwick, the first half of the year was up 10%. Since 1928, that's only 23 instances. The second half averages 10%, up 83% of the time. The only down years were during the 70s and 80s when Volcker was tightening, which the Fed's not, which gets to the third point. the Fed's embarking on a rate path to neutral. That means there's like 200 basis points of cuts coming, 300 maybe. The Fed's got your back, and so that's why I think it's going to be pretty bullish for the next 12 months.
Okay. Want to talk about the Fed, or we?
Yeah, no, look, I think one thing with the Fed is, I think the big question, it's no longer, a question whether they will cut rates, to your point, right? It's a matter of how much will they cut rates by, and maybe even in September next week, how big they'll go. I mean, I've talked about this. I mean, I think there's a lot of contention around this idea. I do think the Fed is behind the curve, mostly because I think a lot of labor market indicators are in a downtrend. Now, the unemployment rate has gone up from 3.8% about 6 months ago to it's about 4.2%, right? Yes, it fell from 4.3 to 4.2 in August, but that's because of rounding, right? Went from 4.25 to 4.22%. I think generally we are seeing the glass half full look is labor market indicators are softening only gradually. And I wouldn't say we are in the middle of a recession, or we are very close to one, simply because so many other data points are still looking okay, right? But there's a risk out there. I mean, if you look at the unconditional probability of a recession 12 months out, any year, you'd say, okay, maybe it's about 10, 15%. I would say right now it's 25%, but also conditional on the fact that what you just said, I think the Fed has the labor markets back. And labor markets, why do they matter? Because 70% of GDP is consumption. Where does consumption come from? Incomes. Where does income come from? The labor market. I think that's the whole ball game. I think the good news is that the Fed's got the labor markets back.
So let's dive in a little bit. So the Fed meeting is next week, right?
Next week.
And the general consensus is what, 50-50 almost, Tom? Will they go 25? Will they go 50? This is an argument all the time on TV. If they cut 25, the market might like that. If they cut 50, it means they're admitting they're behind the curve. Will the market like it? Will the market not? What do you think? Let's say hypothetically they cut 50. Will the stock market like that, or will it not like that?
Friday's jobs report, which was the August report a couple days ago, made people worried that the Fed cut of 50 would be a panic cut. I think that fear is subsiding, and so tomorrow we get CPI, and I think if it's really tame, a 50 cut looks dovish because it's like back to normal. One thing I'm really glad about is I don't think this rate cut is being politicized, because there was talk earlier this year that the Fed was going to be viewed as pushing for one candidate or another, but it seems like that's not even in the dialogue, which is good.
Anything else you want to wrap up on the Fed here, Sonu?
No, I think, look, I'll put it this way. I think everyone kind of agrees the neutral rate, which is essentially that the rate that's not too tight, not too loose, is higher than what it was in the 2010s. Maybe it's close to 3.5%. And when the Fed hiked rates to 5.5 last July, the last 100 basis points of cuts was essentially, or hikes, were insurance hikes. I think they can take that off. And, that will be positive for markets. So hopefully they do that sooner rather than later.
Yeah, and maybe what I'd add is some people have sort of put the theory that, well, they probably realized that in July they should have cut. So if they do 50 in September, they're saying, well, we're just doing a catch-up because we probably should have cut last month as well.
So let's talk about the election a little bit. That's the other big thing that's out there. Obviously, the Fed's coming up, the election's coming up. Tom, you do a lot of research on this. Our stance, we've talked all year about this, is important to separate your political beliefs from your investments. We've seen many people get worked up, of course, in this room with your clients out there. You know where this is going. The clients, if so-and-so wins, if so-and-so loses, they want to buy, they want to sell. You've done a lot of great work on that. How should we view the upcoming election, and in theory, if so-and-so wins, what might happen, what might not happen? What do you think, Tom?
Well, maybe I'll start by just acknowledging we know there's really divergent views, and it's a very contentious election, and it's super close. And we know that that's playing out in the stock market because people really don't generally separate emotion from their action. So that's why we think volatility is high into election day. Do I think either candidate changes what the stock market does the next 2 years? I think the business cycle is more important. So I think under either Harris or Trump, we're still talking about double-digit gains for the S&P. But there's a huge difference in how sectors perform. So I might suggest doing something backwards, which is Trump is pro-Bitcoin, he's pro easing, deregulation, that's really bullish for small caps and financials and for crypto. And if those are acting better, that's the market believing Trump is going to win. And at the moment, I think the market is literally following the betting markets and think this is a tight 50-50 race.
So, let's go sectors for a second then. I mean, financials, industrials did well yesterday. We like cyclicals. Tom, I think you do too. But let's talk. How are we constructing a portfolio right now in our Carson House views?
I think it falls to the fact that, look, we don't believe a recession is imminent, right? At the same time, if risks are rising, we want to have long-term treasuries as a buffer, as that hedge. But because we like the economy right now, we like small caps. Yes, it's been a little frustrating. I do want to get Tom's perspective on the Russell 2000 after this. But we like industrials and financials. Those are sectors that we think would do well. I mean, I think there's a lot of talk about, what about technology and NVIDIA driving things and things like that. But look, we've been neutral on technology for a long time. And tech is already a big part of our portfolio by itself. It's close to 25-30% of the S&P 500. Do we need more? We don't think so. It's still the largest sector in our portfolio. So we like, sectors like financials and industrials.
So Tom, let's go to the small caps. Obviously, you made a name for yourself with some pretty big calls on small caps. We've been slightly overweight small caps as well. Been frustrating. How do you see small caps here?
I still like small caps, whether that's the IWM or the S&P 600 ETF IJR. It's really your best bet if you believe the Fed cuts are going to relieve a recession that's happening in housing, car sales, and durables. And that's our bet, that there is stress in those parts of the economy. And as soon as the Fed cuts, you're alleviating cost of money while there's pent-up demand. And that should be a huge tailwind for small caps. You're not paying a lot for this right now. The average stock in the Russell is trading at 10 times earnings. That's compared to 16 times for the S&P. Russell earnings growth in the second quarter was growth of more than 19%. In the third quarter, it's accelerating to 39%. So you're getting a lot of earnings growth for 10 times earnings. And then all you have to bet on is that the market expands outside of tech when the Fed starts cutting.
Add to that?
I'm curious about tech. Just getting to the tech aspect of it. Do you think tech's had its run? And I'm curious about your thoughts about AI and all of that too.
I don't think tech's had its run if you are talking about a 3 to 5 year view, because part of our central work since 2018 is that the boom in technology is primarily being driven by labor shortage. In the next 10 years, the world is short roughly 80 million prime age workers. That's close to 4 trillion of wages that need to be replaced by technology spend. So we think tech becomes 50% of the S&P. Without the FANGs. With FANGs, it'll be 60 or 70. But in the short term, I don't think tech is as exciting, because if the Fed starts easing, growth isn't scarce. So when growth isn't scarce, investors are going to be focusing on quality or, PEG ratio, low relative multiples, and that's industrials, financials, and small caps. And financials, industrials are already reflecting that shift.
Interesting. So again, we're about the halfway point of episode 100, Facts versus Feelings, celebrating the bull market with Tom Lee, live from Excel, being live streamed as well. So we lost a giant in our, not our industry, but in our world yesterday. Darth Vader passed away. I know both of you are fans of Star Wars. Sometimes we talk pop culture on this podcast. Sonu, your birthday. When is your birthday?
May 4th, right?
May
the 4th be with you.
Yeah. So again, James Earl Jones passed away. I know you wanted to say a couple things, and Tom did as well. James Earl.
No, I'll just repeat one of his lines, which I think applies to Bears right now. Like, I find your lack of faith disturbing.
Well, you're not using the voice.
Yeah, I can't do the voice.
Yeah, you got to do the voice, Sonu.
I'm not a baritone. No. But yeah, no, it was a little gutting. That's sad. But speaking of James Earl Jones, by the way, one of my favorite roles, beyond Darth Vader, obviously, and The Voice, was his role in Hunt for Red October, which is really cool. So, yeah. No.
And Tom, I'll go to you in a second. Just when he passed, find this. It's out there. But David Letterman did a top 10 list, and James Earl Jones read the top 10 list. That's all you got to know. Just watch it. It is hilarious. That was trending. James Earl Jones, Darth Vader, Star Wars, Tom.
Yeah, first of all, James Earl Jones' voice is for a generation only associated with one person, Darth Vader. You don't even know who Darth Vader looks like. You know, you just know the voice. And as many people know, Star Wars inspired a whole generation of Gen X people to go into aerospace engineering. I mean, things like SpaceX today, a lot of this is because of Star Wars.
Yeah. So let's again one more, Tom. So you've created a business. What you started in 2015 with Fundstrat? Is that correct? Around
September 2014.
2014. Wow. So obviously we've got a room full of financial advisors, small business owners. What are some of the big takeaways you've learned that you had no idea, you know, this time 9-10 years ago?
And congratulations on 10 years.
Thank you. 10 years this month.
10 years. Oh, wow. That's neat. Another big celebration there. But what are some things you've learned? Maybe some takeaways for small business owners in the room here.
Well, for people who are small business owners in the financial industry, I'm assuming, you know, that's what we are. You know, we started this company with just a handful of folks, a lot from JP Morgan, and there's Steve Quinn in the audience, who I've known for over 20 years. And I think what I've learned as a small business owner, especially coming from a huge company. I mean, I came from JP Morgan, where there's 200,000 employees, and there were 7 Thomas Lees. And like, wow. I had to fight to make sure they didn't change my email from thomas.lee to thomas.x.lee. I had to write all these letters. But one of the things that I think that we've learned as a company is culture is so important. Like you know, every person that we do hire, we obviously are looking for bright and talented people, but we really focus on ethical people and people that we can trust, because our business is based on trust. And if it's one thing that we've learned as a company over the last 10 years, is that that's the reason people, you know, come to us and find us. I think another thing we learned is that marketing and the way information is communicated has changed in the last 10 years. You know, people, you know, 10 years ago, you just needed to have a good email list or a Rolodex and you called people. These days, people don't use their phones as much. And so, you know, platforms like X are incredibly important. I would say what shocks me is news today breaks on only 2 platforms, Reddit and X. I don't think if you're reading the New York Times or Wall Street Journal, you're actually keeping up with really what's happening in markets, whether it's, you know, a trade blowing up in Japan or some weird credit event in Venezuela. These things break on X now. So that's something that we've really learned. And I think the third thing that I learned is that the investor has gotten a lot smarter. You know, like, I don't think there's really anyone, it's not fair for someone to say, oh, retail doesn't know what they're doing. These guys are very talented, and there's a lot of sophisticated people that decide to actually start their own shop. I mean, technology has allowed a lot of scale and access to information that gives a small investment team the same ability to generate alpha as any of these large firms.
Well, I love it. I mean, this is, again, it's episode 100, right? I think you look at the Carson culture, right? We show up every week, right? We're going to be there. We love what we're doing. Sonu, your opinion, or your take in a second, but I've been here for over 2 years, and I truly love what I'm doing every day, getting to meet, believe me, these lights are so bright, I can't see anything in front of me, but so many friends out there walking around, and it's truly an amazing culture that we've created. I know Bert's on the stage in about 13 minutes, so good luck, Bert. And he's going to talk about culture and some other cool stuff as well. But it's been an absolute blast. Sonu, you've been here 5 years. What's some of the things you've learned and takeaways being in the Carson culture that we have here?
I think it's so important to something Tom said. Trust and credibility is so important in this business, and that's with communication, right? And getting everyone together here, I think, is, you know, part of enhancing that communication and then generating creativity out of that, right? I mean, I think of what we've been doing over the last few years is it goes back to creating stories, right? It's not just about data, right? And you need a narrative. Now, you don't want a narrative where, you know, things like, oh, you know, M2 is doing this, or Quad 4 is doing, Quad 4 or Quad 4, whatever it is doing that, or LEIs and things like that. You want to look at the totality of the data and create stories out of that, because ultimately it's stories that connect. It's not just, oh, here are 10 charts. Now you do what you do, right? No, that's very difficult. You have to communicate what's the story of those charts, what's the story of that data. I think that's what we, try to do here. And I think that's what we honestly do better than a lot of other folks.
Oh, absolutely. So Tom, we've got a little over 10 minutes or so. I want to be very clear. We don't really have an opinion on Bitcoin, but the question comes up a lot. I know you have some strong opinions on Bitcoin. How do you see that?
Well, we're still recommending Bitcoin. We started writing about Bitcoin 9 years ago.
Okay.
And originally we recommended investors put 1% of their portfolio into Bitcoin, or 0.5 into Bitcoin and 0.5 into Ethereum. And at that time, what we had written about was that even if you don't believe in blockchain and the security of the Bitcoin network, 90% of the move in Bitcoin was explained by just two variables, the number of wallets and the activity per wallet. And if you projected that out, we thought Bitcoin could get to 25,000 by 2022, which was like a 20x gain. It turns out it hit 22,000 in 2022. If you do the same math for Bitcoin now, the number of wallets could still rise by a pretty big, what they call log function. And, Bitcoin could get to, I've heard numbers like Michael Saylor yesterday said 13 million. They're not crazy numbers for Bitcoin if it becomes a mainstream form of financial transaction. But here's the interesting thing. Our 1% allocation, when we first recommended it, today is over 40% of someone's portfolio. And if they did 0.5 in Ethereum and 0.5 in Bitcoin, it's 80%. So I still think it makes sense to put 2% into Bitcoin. BlackRock is recommending arguably a larger allocation. I mean, it has become an asset class, and it's your hedge, because in the event that the dollar becomes questioned or sovereign, the sovereignty of an individual, then Bitcoin could have a huge step function move, and it makes its gains in 10 days a year. So if you don't own Bitcoin and just sort of hold it and forget about it, you're going to miss out on most of the gains.
Do you have a target for Bitcoin now?
Yeah, our team, we have a crypto team. It's actually 4 people that research Bitcoin basically every day. And they think it's going to be over 100,000 by the end of the year, with most of that move coming after election day. So it's part of this halving cycle. I think that's not crazy. I mean, Bitcoin is, 58,000, but in the next couple of years, could it be mid 6 figures? Again, it's not a stretch, because the one thing is everybody in this room is above average in wealth, and the banking system works in your favor. If you're not wealthy, if you look at OECD data, the average person spends almost 6 weeks of their salary a year to pay for their bank account. That means they're paying more to use the banking system than they are paying in taxes. So it's really expensive. It's roughly 4% of all global GDP is spent to pay the banking system. It's a huge tax for most people.
So Tom, you get to talk to a lot of people. You travel the country. When you present and talk, I mean, what's 1 or 2 things that you think most people should know, but maybe they don't know, right? You guys do so much cool research. I mean, what's something you tell the room and they're surprised maybe when they hear that?
Well, there's one thing that I think doesn't get presented a lot, and we do show it in our charts, which is the stock market pretty much just follows demographics. And it's actually the number of people aged 30 to 50. Okay, so if you go back 100 years and you did a chart that just says people aged 30 to 50, that's prime age workforce, track their 5-year growth rate, that has explained 10-year S&P rolling returns for the last 100 years. It has marked every single major top. That number peaked in 1929. It peaked in 74. It peaked in 2000. I'm forgetting, 2007 or something like that. And the next peak is 2035. So every major market peak just follows the number of prime age Americans in the US.
I was going to ask, when's the next peak? So 2035, we've got
so you'll be 15,000. Then you just keep your profits, right?
Yeah, I do want to point out, I mean, you guys have a booth. The booth in the room next door, right to the right. Go visit Tom and the team and learn a little bit more about Fundstrat. I think, you'll be at the booth later today, right? Are you flying home? Your team will be there.
Yes. Yeah, our team's sticking around, and we do have a little basketball hoop up there if you want to take some Rick Barry shots over there.
I tried. And
I shot one and it fell and literally knocked a beer and ran right into a laptop.
Almost broke a glass.
Almost broke a glass. Sorry.
speaking of things people don't usually talk about, in our business, it's not just about predicting things. It's also, we are essentially in the business of trying to predict what other people will think about, events and how things are priced, right? It's about thinking how things are mispriced or not. So from your process, really, how do you figure out when to fade the consensus versus when to ride the trend, when to believe in momentum?
Yeah, that behavioral finance element is so important in the stock market because number one, most people are their own enemy because price governs your sentiment. So when the market's going down, everybody wants to sell. And then at maximum pain, that's the market bottoming. So part of our work in really doing consensus work is to make sure people don't make that mistake. And so I think it really comes into play at the extremes. I'd say consensus is right like half the time. But last week's a great example. The market's down 4% on no fundamental reason.
Well, you were on CNBC Monday morning and said it might be weakness.
That was a fundamental reason.
Yeah. But now we're at the lower end of now you should be buying because you're really at the lower end of how bad things could get. And that's the thing, you should be buying this dip. But most people probably liquidated, shut their books and said, I don't want to do anything. This is the time you make money. So I think that variance versus consensus is really important. It prevents you from making mistakes.
So we have 5 more minutes to go of Facts versus Feelings, episode 100, celebrating the bull market with Tom Lee. Bert is up next. Tom, the question I like to ask a lot that I probably asked you last time you were on our podcast, and thank you again for joining us again in person this time. Some mentors. You've worked with a lot of cool people in the industry. What are some mentors and some things you've learned that our partners here in the crowd can take away and help their businesses grow?
Yeah, well, number one, I think it is so important to have mentors. I would say that that's really been so important in my career. I've been working in Wall Street since the early 90s, so 33 years.
Wow.
And I would say at many key points, it's always been a mentor that's either just spent some really good advice that I hear in my ears, or the ones that have kept me in mind for something and allowed me to actually sort of step up. And so I think it's always important for people to not only have a mentor, but to be a mentor. And, for like us at Fundstrat, many of us, not only mentor our employees, but, I'm involved with a lot of nonprofits because I know how important it was for someone to kind of have a view of someone else's career with a lot more foresight, right? Because when you're young, you just don't really know what the future holds. And actually the future is uncertain. And actually reality is most success is kind of accident. Like I think my career is mostly luck. So I think it's important to have mentors to help guide young people who are, dejected or feel disappointed.
So one thing that is certain, in the room next door, we have a booth. Like these shirts,
yes.
We have some of these shirts next door, and they've been very, very popular. So definitely come visit us at the booth next door and get a Facts versus Feelings t-shirt. Go ahead, Sonu, with a
and do the survey too for the.
That's true. There's a catch. You got to do a little survey.
Yes,
but
you got to give us some feedback. Now, coming back to markets and the rest of this year, what's your target for the S&P 500? Just to remind everyone. And do you think? And you said obviously the market's down now. May not be a bad time to buy given where it is. Do you think a lot of the rally, presumably you think the S&P 500 will be higher than where it is now, does the rally happen before the election or after?
Our base case for the markets originally was in December, more than a year ago, we thought the S&P would get to 5,200, which was roughly a 20% gain. I still think we're going to gain 20%. So I think that the end of this year, S&P will likely be closer to 6,000, and it's at 53 right now. Our original thinking was the bulk of that move would be in November and December. So we could be range trading, and then we have a huge step up as the election is done and people commit capital. Mm-hmm. But as the market sold off on last week, it making me think that we're front loading a lot of this. So I think there's a possibility that rally could start sooner if the market starts to believe the election outcome is is much more decisive. But right now it's so 50-50, I don't think investors have conviction.
So somehow every week I ask you this on our podcast. What should investors and listeners to the podcast be watching for this week? What are some big news events?
What's your Twitter feed? What's your Twitter feed? No, look, I think following a plan, right? I think ultimately that's what everyone here does, following a financial advisor's plan. I mean, there are so many potholes along that path, and staying true to that story, whether it's a short term and following someone like Tom's forecast or what we believe too. We're still bullish. We're overweight equities, despite thinking, yes, risks are rising, but that's why you have hedges in your portfolio. Yeah, we're bullish for the rest of this year, but we are bullish on even a much longer time frame, right? Tom talked about S&P 15,000 by 2030. I mean, we don't make a target like that, but it's still very bullish. I think sticking to the plan ultimately is the best thing, and that's what financial advisors are here to help with.
So from a macro point of view, is there any data this week, though, we should watch?
CPI, I think.
CPI.
Hopefully, here's what I'm hoping will happen with CPI tomorrow. It gives a lot of Fed governors and Fed officials who think, we should take this gradual, prudent, careful approach. Now, interestingly, Powell didn't use any of those three words in his Jackson Hole speech. So I think it's going to come down to Powell himself as to whether we get a 25 basis point or 50 basis point cut. But hopefully for all the gradualists on the FOMC, they see the CPI data and finally feel comfortable that, okay, the inflation problem has been solved.
Sure.
I do think they got head faked by the inflation, harder than expected inflation in Q1. But like I said, it was a head fake.
All right. I'm looking at the clock. We're almost at triple zeros. Everyone, thank you so much for being here. Tom, thank you so much for joining us for a live version of Facts versus Feelings, episode 100, celebrating the bull market with Tom Lee. Thank you, everyone. We'll see you next door. Enjoy the rest of this. Burt White is next. Thank you.
All right.